mentioned that finding Peter Lynch is very tough. You rarely find a fund manager like Peter Lynch, which is the person, the fund manager who grew a $20 million fund to a $13 billion fund. It is it's a very hard task to find a fund manager like that. So of course, one way behavioral finance is correct because if there is a large trend behind you, and if there is a large secular bull market behind you, then of course stock selection becomes an easy process. And maybe this is the reason they also ascribe it to an underlying trend. And but yes, they do. It has been seen. It is not about just about the subject itself, but statistically, it has been proven that it is very tough to beat the market. If rather than paying a fund manager for fund manager, most of the fund manager underperform the market. So the fund managers delivered more losses than the market did, and which is again a statistical proof. It is nothing which can be denied here because it is a study and which is correct. So beating the market is a hard task, and very few people can actually beat the market. And fund managers, especially 80%, 90% of the funds are go up with the market, and 80%, 90% of the funds go down with the market. So if you are paying fund managers an additional premium to manage your money, you have to do a lot of effort in selecting that fund manager. So your your skill set is about finding that right fund, finding that risk strategy, or finding that person who can outperform the market. Investment clubs also are the ones which are known to have failed and bombed, and investment clubs are also have poor accountability and a lot of gap between anticipated and happen. And because too many cooks spoil the profits. If you have a management portfolio managed by four or five people, then the possibility of decision making, or the decision making could be biased, because the research of Barber and Odeon says that too many cooks spoil the profits, and they studied the management committees and investment clubs, and they generally had biases in their thinking as a group. One has to the decision making has to be independent, and if you involve many people to take the investment decision making process, they are known to deliver less than an independent decision maker. And then of course it comes to various other things like how much is investor autonomy worth, and the investor freedom, how much freedom is good for him. And there are studies also that on average the holding period of investors have been falling. There were some time back in a secular trend, the investment holding period were above average more than 12 months. As secular trends change, the average holding period starts to reduce. And it was not 12 months, it was less than a year still. But with passing time, the holding periods are starting continuously reducing. So the investors are really not concerned, or their holding periods are really becoming smaller, and that's why they say that they're asking that should the investor really have the voting rights. If he's holding a company for 3 months, how can he know about the long-term vision of the company? Now these are the new thoughts that are being raised, that if your average holding period is less, then why are you so concerned about the long-term growth of the company, because you are only holding it for 3 months. So these are some of the thought process that's going on today. And there are then they were saying that if you let the investor decide on his contribution plan, that where should he invest his savings, the contribution which is made by the company where he works, then are the investors doing a good job of it? So then the study proved by Benartzi and Thaler that that investors really do not have a preference or choice, and they generally do what their colleagues are doing. If you want me to put in some fund, okay, I'll also put the money in that fund. So the thinking process, the preferences, the choices of investors are not very clear. And even if you give them more autonomy to decide where to invest, they do not do individual thinking, and they don't have an ability to select their own portfolios. They do not have clearly defined choice, and they prefer the portfolio of their peers or their neighbors. And this again was highlighted in this paper that the investor freedom is not really changing his portfolio performance. Then and then we are talking about other errors, which is that um, framing. We do a kind of mental accounting. So we don't see money as one portfolio. We don't see a portfolio as an integrated entity. We see the portfolio as um, as a separate account, or our money as a separate account. If there is some money which comes from inheritance, then we are in that case looking at that money as separate. And if we are getting some money as salary, we look at that money as separate. And if we get the gain in the stock markets, we look at money as separate. And if we get a dividend from a stock, then we look at it as separate. So we have some frames in our minds which is causes a bias, because at the end of the day it's all your total portfolio. Whether you lost money on a stock and you are having an illusion that okay, I got my principal investment back because the stock gave dividend, so I did not lose my portfolio size. But again, you did lose money if your portfolio came if the markets came 90% down. So we have a way to avoid regret. We have a way to avoid pain, and it's somewhere we make frames in our mind, which helps us uh, feel safe, or somewhere elude ourselves. So they say that loss aversion. They say that the study says that if you are losing money on a stock, which is uh, which is considered different than if you are losing money on the portfolio. If you have a stock and you're losing money on the stock, you behave more reactive. But if the same percentage you lose it on a portfolio basis, you say, "Oh, it's my portfolio." So the how we see things differently is what behavioral finance errors talk about. And at the end of the day, one they are very right that how can you treat a loss on a stock separately and on a portfolio basis separately? Ultimately, if the percentages are the same, the losses are the same. And there were discussions about earning surprises, growth expectations, stock returns, on which also was discussed by Hand in 2002. And there is growth and value framing. Now, again, this is a big stock market theory, which says that there are growth kind of stocks and there are value stocks. Growth stocks are the ones which give capital growth, and the values are the ones which are inexpensive and long-term value. And and this again, such a large theory of growth and value. Behavioral finance says it's a way we see things, because there is nothing. This is a kind of a mental framing, a mental way to see a kind of stocks and a kind of stocks. I do not really agree with this, but I personally believe that growth and value are clearly distinct groups, and there's a lot of proof in terms of growth and value cyclicality. And but behavioral finance considers it another way of our mind to elude ourselves, or it can generate biases. I already talked about the inheritance account and the salary account. Salaries we treat in a separate way. Inheritance we say okay, that is some inheritance which is in a separate account in our mental mind only. That 5,000 euros, that 50,000 euros we have, that is something we have kept separately for that. But again, it may be part of the same pie, and which they say is a bias because it is the same money. Momentum investment is at the heart of investor errors, and which again the this kind of investing is basically trend following, extrapolation. If market is gone up today, it should go up tomorrow. If market is gone down today, it should go down in the next days also. This extrapolation or trend investing, they say, is at the heart of major investor error because they do not know when to stop. They will just, if the markets are going up now, there are so many traders who are sitting at the at their trading screens, and when markets start to go up, they see volume, they start buying, and when the market start go down, they start selling. Now this behavioral finance says is an error because it is at the heart of all mistakes. Major mistakes are done by investors because they follow the trend. Now, somewhere this I agree because trend following also leads to extrapolation. Extrapolation also leads to bias. But again, I don't think that trend following is really an investor error because there are scientific ways to establish a trend which behavioral finance doesn't agree. Then there are other errors also which says that the disposition to sell a winner too early and ride losers too long is also an error, which says that if we if we have a gain, we tend to book it fast. Oh, I have a gain. Let me book it fast. But when I have a loser, I tend to procrastinate. I tend to delay, and I want to average, and I will say, okay, I'll somewhere it is harder for me to accept a loss than for me it is to accept a gain, and that is one of the reason I tend to um, get out of my winners faster. And this is a behavioral error. So I have to try um, to let my winners run longer and cut my losers fast. And this is another mindset which has to be nurtured, which has to be developed, which has to be thought over, that why I sold Sif Chinch at Chinch Lasuta and it went to give Chinch Lasuta. So how, what are the approaches? The behavioral finance says I'm predisposed to cut out my Trasgas with a 10% gain, then I'm uh, then I'm disposed to cut Trasgas at a Sutala Suta gain because that is how I'm genetically structured. And to overcome how I'm genetically structured is the reason I need to understand my psychology. I need to understand how human beings behave, and predisposition towards get evenitis. This again is a kind of averaging. Averaging is not written just in behavioral finance. Averaging or getting even is uh, is also is also a very known idea where people say, okay, I have a small loss, I'll buy a little more, my mean average price will go lower, or if I have a loss making stock, I'll hold it till the time it comes back. I don't want to close it because I'll be forced to mark a loss. Booking a loss is a extremely tough task, and I cannot do it because behaviorally I'm inclined to not book a loss. I would rather hold on to a loss till the time it becomes a profit. There are 1929 people held stocks and they kept holding it till 1942, 43, 44, 45 when it came to 1929 high and they sold it. And after 1945, the markets rose 50 years more. So the idea of getting even, the idea of selling winners early, the idea of not accepting a loss are human psychology. So how to overcome it, how to beat it, how to think through